Checking.
All right, folks, if you can find your seats and finish up your conversations, we're going to get started. So for the next panel, we're going to be talking about investing in platforms, marketplaces, and ventures with stakeholder ownership and governance. So you can think of the last session we just came out of as really giving us the 30,000-foot view, the context, what's going on. And now we're going to completely switch and talk about how do you launch new ventures in this space? What are the considerations from folks who've really been working with entrepreneurs from the ground up for the last 5 to 10 years? And I mean, I'm speaking only to the stakeholder governance side. These folks have been working with entrepreneurs in some cases more than 20, right? So, but we're really going to be zooming in on what does it look like to start from zero in some of these situations where you actually want to start a new venture, you want to call it whatever you want to, distribute it, decentralize it, just incentivize your stakeholders to participate and grow it, right? So why don't you folks begin by introducing yourselves? David.
Oh, thank you. Hi, I'm David Pakman. I'm from CoinFund, where I'm a managing partner there. We're one of the oldest crypto native investing teams. We've been around since 2015. We invest in seed stage, early venture stage, and liquid stage crypto, Web3, blockchain companies. Before that, I spent 13 years as a venture capitalist at Venrock, focused on early stage Series A deals. And before that, I was an entrepreneur, started 3 different companies. Nice to see everybody.
Cool. Hi, I'm Stuti. I'm with Kraken Ventures. And Kraken Ventures is, I think, one of the most unique structures for a fund in crypto in that we are anchored by Kraken, the digital asset exchange. But majority of our investors are externals so that we have total independence in decision making, but we still have this awesome partner when and if we need it, and when and if our portfolio companies need it. We focus early stage, mostly financial infrastructure, technology infrastructure. And prior to this, I was doing traditional VC investing in Europe, as well as America, as well as Israel. And prior to that, I was product manager and started career actually in public finance, municipal finance. Yeah.
And I'm Jake. I'm with L1D. L1D is a Swiss-based crypto-focused venture and fund of funds. We focus on the venture side on mid to later stage venture. Before L1D, I spent several years on the research and trading side of crypto. And then in around 2020, started to dive into the governance side, working with several DAOs, including MakerDAO, Threshold, eventually starting the Boston DAO and Spearbit.
Jake and I did not coordinate our outfits today, in case you're wondering. I'm going to set a little bit of context here for just investing in crypto and what's happening in financial regulation, some of the considerations around the world. And then we're just going to hop into, like I said, we're going to get into the meat of this. What is it actually like to start from zero, to talk through a term sheet, to think about how to include a broader stakeholder community in something you're building, whether it's in Web3 or not. So in the US, if you've not been paying attention, there has been quite a bit of regulation. A lot of the hammer from the CFTC and the SEC, so to speak, has been thrown down. But there isn't really that much regulatory clarity still on what is and isn't allowable, what is and isn't a security. Of course, people point to the Howey test, and that, which we'll get into later, of course. But the other bit of this that we think is interesting and which we explore in the podcast is that when you think about some of the oligopolistic incentives that have kind of emerged from the last tech wave, right? You basically had 2 things happening. You had, platforms like Meta, platforms like Facebook, attracting users and then extracting from them, and really like kind of a adversarial, not necessarily adversarial, but not necessarily good for users dynamic either. And some Web3 protocols have looked at this and said, that's actually something we should go after. We should open up user ownership to these marketplaces. And then on the other side, you have developers and creators who have been attracted to platforms, contribute code to them, but then basically there emerges, once you have a strong aggregation of them, you have this sort of cooperate and compete dynamic that emerges. You cooperate to get them through the door, but now you have competitive incentives. You're going to control how the API is used. And so a lot of Web3 companies have looked out there and said, we should also think about that. How can we incentivize developers, maybe with a token, to build our platform, to become involved for the long term? And then, you zoom out to the world, and the EU has passed MiCA. Hong Kong and Singapore have also passed their own digital asset frameworks. So within the US, there's a little bit of this monopolistic and regulatory dynamic. Outside, folks are kind of opening up, and it's with that view kind of looking at the entrepreneur and venture dynamic that we're going to start. And so I want to turn to you folks now and just open it up to you and say, as a VC, from ground zero, how do you think about balancing your fiduciary responsibilities with jumping into ownership of a potential network that over time might be owned 60, 80% by not you? So then I'll start with you, David.
Well, I really appreciate your framing of what we're talking about here today. I come to Web3 as an investor largely because of having been in tech for a long time. We know that the internet is really a network of networks, and it's really a community of communities. And the users of these networks and communities have been contributing to the network for a long time, going all the way back to like news groups. You know, people have been contributing knowledge, solving each other's problems in these little online communities, even going back to AOL's chat rooms. And of course, most of the internet runs on open source software, which by itself is a bunch of contributions from independently minded software developers around the world who are contributing. But very little's come back to the users in exchange for those contributions. And I think Web3's sort of reason for existing is to say, is there a way to create frameworks where contributors can have some ownership in the economic upside and also some participation in the governance and the direction of the products that we spend all of our time on. So in comes an investor and says, sure, love this idea. Let's find some projects to invest in. And many of these projects financialize early, much earlier than most software companies financialize. So when you have companies or projects that are financializing early, you impact financial regulation, securities laws, maybe not, certainly tax issues. And oftentimes young founders are not trained in solving for these issues in the early phases. So that's one reason to have investors around the table or boards of governance around the table to help solve for the complexities introduced through early financialization. And of course, the second is like the sort of early stage tech model of bringing together investors, founders, and advisors to help increase the odds of success has kind of worked really well over 30, 40 years. And so we come to this problem and try to work closely with entrepreneurs to increase their chance of success. And so in exchange for that partnership, we get some rights. And I think what you're starting to poke at, which we can explore here, is how do the investors' rights, how are they compatible with long-term decentralized governance of a project?
Very much so. That's a fantastic way to restate it. Thank you, David. So I actually would like to turn to you folks, Stuti, maybe. If we think about this, David's getting into the economics of day zero, right? So traditionally, we've looked at, if you haven't started a venture, you might retain something like 60 to 7% of your equity as a founding team. You'll sell rights to future equity on maybe a simple agreement, safe, if you will, for 10 to 15, 20%, and then you'll sidle along a little 10% there. And that's been the default in these ventures that are not Web3 for at least the last 20, 25 years since Y Combinator debuted the safe, right? And it started being adopted. So I want to now turn to you and ask, what defaults on the economic side have you seen that can kind of help entrepreneurs, their early sort of contributing network, and their investors remain aligned?
So I'll tie this back to your previous question, right? Like the tension between the fiduciary duty of an investor and the objective of the founders, which is really to promote the health of their product and the growth of their company. So where this tension I see, comes into play is, as an investor, I have a responsibility to generate returns for my limited partners and return capital to them, right? Generally I have a timeline that I can do that. But the unique dynamic in crypto that I did not see when I was in traditional VC is that, this term that David used is that companies will financialize a lot sooner than in traditional ventures, right? So you have this idea of tokens, and on one hand, it is advantageous that these tokens go liquid, so that others can, become a part of the community and maybe contribute to the health and the growth of the community early. But one of the biggest risks that I've seen, and this is improving, especially compared to kind of like the 17, 18, 19 cycle, but one of the biggest risks that I've seen is that it is very attractive for both the companies and even more for the investors to see the token go liquid as soon as possible, because now I have liquidity, as opposed to waiting 8 to 10 years, right, for some kind of exit or an IPO. Like, we don't actually have to wait for that in crypto. But the problem here is a company has one shot to release a token. And if you do that too soon, you now have two products that you're managing. You're managing the token and the community around the token, which wants to maximize the token price. And then you're managing your product, which might have completely different underlying utility. You know, maybe it's a decentralized file storage network, right? Maybe it's a decentralized AI training network. It could be a number of different things. So something that, you know, I actually see this improving is you try to tie the tokens utility with the product's utility. You know, in the time of ICOs, as I said, kind of 16, 17, and then sort of that time trailing after 18, you didn't see this as often. You know, there's like even a lot of like hubris, I think, in founders that just want to release a token and say, this is my network, this is my token, this is my community. And now I think people are a little more measured in deciding what is the right timing to release that token and, you know, really financialize their product. And also make sure that that is tied to some kind of underlying product. You know, Uniswap, for example, does like a decent example of this. And I think it is a bit easier with financial applications, because at the end, the token has financial utility. And if you're building a financial application, then it's easier to figure out ways to tie these two together.
And Jake, how about yourself?
Yeah, absolutely. So I'll also go to the first question, bring it back to kind of what we see as defaults. But when you talk about we are a fiduciary, you know, what does that mean? It means that when we take money from somebody, we have a responsibility to do what we are telling them we will do, right? To essentially optimize the returns on that money. So the issue with this is, of course, that, you know, that means that like Studi was saying, our idea of an early exit is a good idea to somebody who's a fiduciary. But often it's not the best idea for the product. And so you have to kind of understand that this entire system of crypto is built with adversarial thinking. And so this isn't a bug, it's a feature, right? You have to build this into the defaults that you roll out. And over time, back in 2017 or 16, when we were looking at ICOs, we were in this kind of price discovery phase where we would try to kind of discover what type of allocation to the community, to the investors, to the team made sense. And people would come out with drastically different allocations, just throwing darts at a wall, trying to find which one works. Now it's been about 6-7 years since the first, since Augur ICO. And we finally have some data to see like, okay, what actually makes sense here and what's the logic going behind this? So to answer the question directly, we've started to come on some sort of consensus. I mean, the obvious thing is that the community at the final stage should own more than the team and the investors, right? Otherwise, it's not decentralized. Okay, take that as it is. You have at least, let's say 40-60, right? So 40% to the team and the investors, 60% to the community. And then I think like it's pretty straightforward. You kind of, you would want to give the team more because as you mentioned in traditional venture, the team typically leaves with a lot more. But in crypto, you're dealing with universal level protocols, right? So the market size is larger, so you can afford to give out a little bit more. And if you can't, it might be problematic. But the way to kind of look at it then is, all right, a standard crypto life cycle would be give out 10% at the seed, give out 10% at the series, and then go ICO, right? And maybe you have an extra 10% stuffed in there, you have some dilution in there, but that's typically what we're seeing as kind of defaults.
Great. So we covered a bit of the economic, how we split the pie. But since you are all active investors, and there are founders in the audience, I saw a few of them on the way in, I think people would love to hear, like, what are some red flags you've seen in how to slice up the pie at the start of a venture, right? What makes you go, no, we're passing on this purely because of this?
Yeah, I mean, to start here, and this is, I would say this is not a red flag yet, but this is something that I'm starting to kind of develop onto as a red flag, which is in the earlier days for VC, we came up with the SAFT. It was brilliant. It was smart. It made a lot of money for a lot of venture capitalists.
That's the simple agreement for future tokens, in case you're wondering.
It's just essentially the equivalent of the SAFE for tokens. But the issue with the SAFT was that there was no backup if there wasn't a token, right? So it's not like you had equity. So you kind of needed this token to come out. So the incentives were really misaligned with the SAFT, because essentially the investors said, your idea no longer makes sense to have a token, but let's go ahead and do it anyways, because otherwise we're writing a zero for that. So recently we've shifted over towards doing equity plus a token warrant. It's a good setup. It's been working well. I think it keeps your interests aligned. But more recently, what we started to see is, in order to encompass kind of that community element I was talking about that needs to be 50%, we've started to see this idea that token warrants have a 2-to-1 ratio, right? So essentially, the valuation on the token warrant is twice the valuation on the equity. Now, yeah, it makes sense because you have to fit in that community component. But also, what you're missing from this is that it goes right back to the default of incentivizing a token despite anything, right? Because now all of a sudden, the best economic upside for the team is on the token launch, right? So we shifted it back to that. So that's something, I wouldn't say it's a huge red flag, but it's something to really think about if you're going to consider doing it.
We went through a period in crypto of sort of Wild West, no governance, no board members, no equity, just tokens, and certainly with your token purchase comes no governance rights as an investor. And a lot of bad stuff happened. What a surprise. You take no general oversight of largely young founders, in many cases inexperienced, with lots of early financialization incentives to make token go up, and a lot of bad stuff happened. So fortunately, we've been going through a reconciliation period where crypto is looking at itself more like tech software company creation, where some basic controls, checks and balances, governance, and advice structures are put in place. And almost every deal we've done in the last several years has included, I would call standard investor equity-like protections, a board of directors, checks and balances around expenditures, approval cycles for stuff. And we don't have, in almost all cases, none of us have majority control. We're all small minority investors, but we tried to exercise some good governance in the early stages of a project to, again, increase the likelihood of success. But I think one thing we've been more and more successful with is helping convince young entrepreneurs that this is also for their protection. If you make a decision by yourself as a CEO without any board or any governance, and the decision goes wrong, you've got fiduciary liability for your investors. When your board is there to help you make the right decision, you share liability among the board, and a board can help protect and greenlight decisions for founders.
Yeah, sure. So I think in terms of red flags, or at least orange flags, I actually find it a bit challenging so I'm an early stage investor, right? If a company that is going for their first check has an extremely detailed plan around tokenomics and token vesting, I actually think it makes sense for them to be focusing on product first. And I often find that too much fixation on the token might actually be indicating a team that is looking for liquidity, and that the token is actually the product that they're optimizing for, not the product that they're actually building. So I actually do not mind if, we are signing a term sheet where it's the token stuff can be figured out later. That is okay. That is actually better. For me, the token is more times than not, it's a liability than an asset. I will tell you, I've been chatting with Jake about this. There's 2 deals that I'm actually working on right now where, in one, the term sheet came from another investor, and in another, the seed round was done by another investor. And basically, both of these term sheets have very accelerated token vesting. So one thing that I think our industry has somewhat converged on now is moving towards kind of traditional VC investing, where you have 1-year cliff and 4-year total vesting schedule. And that's shared by the investors for sure, and usually the founders as well. A few times now, you have some investors that are kind of still have this hangover from the ICO sort of shitcoin era, where they have something like a 75% unlock at year one and 2-year total vesting. And for me, this is honestly almost uninvestable. If the entire market was converging on this, like maybe I'd have to make some amends. But the entire market is not converging on this. So for me, when I see, like a schedule like this, I say, okay, there are some major actors in this round that are incentivized to go for liquidity very quickly. And that's going to create like a game theory pressure on me as well to look for liquidity if they are going to sell their share within, the first year of this token launch. So for me, these are challenging projects to invest in.
Yeah, I think so. We covered economic defaults pretty deeply there. And there, if you're a founder in the audience, right, I think you have gotten some good guidance, at least to where to start from and some landmines to avoid, of course. But now I want to switch a little bit and talk about governance defaults. So David, when we were planning for this panel, you had made a pretty good, really insightful comment on sort of like proxy voting and governance defaults for public companies in the public equities markets. That's all hashed out. There's data on how if you go to, an asset manager who owns 9% of a public company and you tell them like, here's where you should be voting for the upcoming shareholder election, how you position that greatly influences what actually happens in that company and its outcomes for its workers and the broader like stock price and everything. But here, we've been talking about the various communities here. We have contributors who could be technical, they could be not, they could be just token holders. You have the founders, you have the investors. And so I kind of want to ask then, it seems when we started this thing, if you've been in this space for a few years, I can remember the times when everyone was like, token voting is the only thing that matters, and how much of the token you hold determines how you should vote, and that's it. And that reproduces some of the same dynamics that I think Jan was talking about in the first panel around inequality and what have you. So it's not that we don't necessarily have to address inequality. That's not our responsibility, but we all are interested in it, of course, because we want a thriving economy. So I want to ask you folks, what have you seen from the field that sort of, now if you talk about governance defaults, right, there's a large design space here. It doesn't have to be only the investors have 20% of the network, the founders have the 20, and now we just hope for the best, right? There could be all kinds of levels instituted here. A board, perhaps, that has badged NFT voting or something, right? What have you seen out there for the founders where if you want good governance, what does it look like for a public crypto network?
Yeah, maybe I can start that one. But, in life, the only constants are death and taxes. And in crypto governance, the only constants are Discord and forum, right? Of course, as an investor, you need to be extremely well-versed in using these tools in order to actually participate in the governance. And when it comes to how much you're expected to participate, we're assuming that this is somewhat of a mid-stage or a later stage project because they have launched a token. They're asking for meaningful governance on the forum where you actually matter, right? And so at this point, there aren't really that many defaults. We're still in this exploratory phase. At a minimum, as a recommendation, I recommend that you tell your investors that there are important votes coming up because often there are unimportant votes and there are important votes. Some of them are house cleaning or housekeeping things that you just really need to do. And it's hard for investors to vote because, frankly, we have to follow procedures such as internally we have a governance procedure where it takes us at least 3 days to vote because we have to go through an internal committee. We have our assets in cold storage and like trying to actually get on chain to vote is not nearly as trivial as it is for a standard token holder. And so for an investor to participate, there's a lot, the burden is much higher. Now, what I have seen that has worked really well has been like direct communications with the investors prior to the post coming up or the governance coming up, workshopping the idea with like large stakeholders. This tends to work really well, and ultimately the investor has to realize that their opinion is simply an opinion, right? It's like they aren't going to necessarily get what they want, but it's a lot better if they're not surprised by this, right? And that has happened. I mean, I think we're in a similar deal where there have been surprising governance proposals. But yeah, maybe I'll pass it over to one of you.
Sure. So, okay. So as I said, I'm an early stage investor, right? So one thing that I see is, we will invest in a project before the token launches or before the project becomes a DAO, right? And then they hand over governance to a community as opposed to doing it on their own. I will just put in one byline here, like that is the perspective of an early stage investor. Sometimes this can definitely be a challenge because as early stage investors, we're really making a bet on a team's ability to make decisions and execute on those decisions. And if they then become a DAO and hand that responsibility over to a crowd very quickly, it can sometimes feel like the Wild West and wonder, okay, what has happened to like our investment thesis here? Because we didn't necessarily make a decision in the DAO that has now assembled and their ability to make decisions. So, I mean, that is definitely one thing to take into account. But one thing I do find is often early stage investors are not as engaged. And this is just kind of like a, recency bias, right? You're thinking about, who came into your most recent round, who are you talking to most often? So one thing that I would find a lot more helpful is if there were processes to actually engage investors into important forum votes or important forum discussions. Since, like the two places that I live are like Telegram, right? And Discord. And this is just like hundreds of notifications every day across a lot of different channels. And maybe if one of them says like, we're making a major decision around whether or not to pay back a loan. And that has happened before. That could totally become buried, right? So a lot of this, part of it is, of course, the responsibility of, the founding team or the leadership team to make sure that appropriate stakeholders are actually engaged for votes. But a lot of this is also in improving the tooling that goes into, decentralized autonomous organization governance and coordination. And I think this is actually one of the most important issues in crypto since, really the promise of crypto is to be able to bring together disparate organizations and individuals that may not know each other and in a trust minimized way come to a decision and have social coordination amongst them, right? So really improving the tools and the processes around that, I think, is one of the most pressing issues for us.
Complicated topic. So I think governance falls into a bunch of different categories and across different times in the life cycle of a company. So we talked a little bit about early stage governance, maybe pre-liquid. It's a small group of people around a table helping a founding team execute. Now we've had some financialization. We have a liquid token in the market, but it's not super well decentralized yet. So there's a lot of investor concentration and team concentration in the ownership of the token. We need a good governance model for that. And then finally, you're talking about a more mature stage of the market where the token is widely distributed. It looks a little bit more like equities markets. But in this case, like it's not just investors who are holding the token, it's users. That's what's so unique in these in Web3 is that like our customers, in many cases, they could be software developers, they could be end users, are holding tokens in these projects and are participating in governance decisions. So now you're wrestling with a whole bunch of questions. One is like, well, which questions come up for votes? There's software questions like product improvement proposals and directions for the architecture of the code itself. There are treasury decisions. How should we invest the money that we're holding in our treasury and should we pay loans back? There are team-oriented decisions. How should we organize? Who should we be bringing in to spend more time working on the project or not? So complex set. I don't think we have a good answer here. So a lot of good examples of stuff that hasn't worked. We have a couple examples of things that are working okay. I can give a bunch of examples that mostly that haven't worked.
Please do.
So a good one is, I'm sure nobody would be surprised by this, but if we just say it's one token, one vote, right? Sort of like populist level voting, do we think that the community will make the best decisions? Well, probably not, because I think we've looked at voting systems through the history of democracies for a long time, and it doesn't always produce the best result. Why? Apathy, indifference, like people not paying attention, horse trading behind the scenes that kind of corrupts the intention of the community. So we have a lot of experiments of that. Nouns DAO might be one, where this is a super interesting project that was launched maybe 2 years ago. And it was really an experiment in decentralized governance. Every day there's an auction for a new NFT. The winning buyer automatically gets a place in the DAO and can now participate in votes. And 90% of what was paid for the noun goes into the treasury. So the treasury starts growing pretty big. The founders, the nouners, are very active in the community. They're help shaping in the Discord and in the forums public opinion about what we should be doing. But over time, the DAO got extremely permissive. Almost every project that came up got greenlit. And so lots of money's going out for random small things with very little accountability. No surprise, because no one really has like a proper stake in decision-making and ownership. And over time, the founders, the nounders, kind of backed out and didn't do a great job of working with the community, and everything went to shit. It was, just a total mess. So, what is a good example of something that may be better than this? Some form of delegate-based voting or representative voting. And the last quick point I wanted to make was, in the equities markets, the defaults we were talking about, you have, I think it's called ISS, right? Like Institutional Shareholder Services. And there's another firm too. They pay attention to all the public company board shareholder votes, and they make recommendations to the shareholders like, hey, we've read all the documents, we're generally independent, we think this is the right thing. We'll need stuff like that in crypto too.
That's a really good idea, by the way, if someone is out there.
This is actually, it is a part of Swiss government, right? So Swiss government, when they go and do votes, they have independent parties draft up what their, what the TLDR is, right? Make it simple, make it layman term, have it reviewed by both parties and accepted, and put it out there so that you can vote on it in an educated way. This would be an amazing default, but that is not the case. Typically, what you have to do is you have to read 40 pages of Rune Christensen's forum post and understand exactly what he means when he says pop and pump and all of these different jargon. And then you have to make an educated vote in 24 hours.
Tough. Before we move on, I love, David, that you grounded us with a real life example. We've kind of been a little bit in the clouds talking about, if you're going to start a new venture, what does it look like? What should you be thinking about? If it's going to be a crypto network, why, how? But I did want to turn and say now, maybe in the spirit of what David kind of enlightened us on, is there an example you'd like to tell us about? Like, hey, maybe here is an example of being well done from start, or even it doesn't have to be from day zero. It could be something that's a bit more mature. Just what have you seen out there where you're like, here's a good example, or bad?
Well done is really hard to find today, but the bad examples are plentiful. I think there was one really, really big mess up, which is, and we've been hitting this point a lot, which is decentralized too early, right? Give the governance out too early. So Arbitrum is a layer 2 on Ethereum. It's a very well-funded project, and a very popular project. And they made a huge mistake this past year. And that mistake was that they essentially opened up the governance too early and trusted people to make a decision too early. So what was the decision they asked? They wanted to do something that was honestly altruistic and it had the right intention. They asked the community if the community would vote on their own token allocation as a team. And this is a really good thing to do. It's a really, altruistic thing to do, but it's not necessarily the smartest thing to do, because you are now giving the community something and then taking it back from them, rather than just from the start saying, hey, this is our allocation, right? And there's no good way to go about this, because either you and all of the insiders vote for it, and then everybody says this was, democratic feudal, or something bad happens and people say no, and then you don't have it. And that actually happened. They said no. And so what Arbitrum had to do was Arbitrum had to tear down the democratic feudal, which, to speak about regulatory consequences, like there are massive regulatory implications from the simple fact that they thought it would be a good thing to do to give the voters a chance to do this. So to go back to kind of like a recommendation on what would be a good way to go about this is, I forget who I was talking to, but they said they've been specializing in governance for a while, and they work on a crypto game, And they said, I don't ask my kids, what do you want for dinner? I ask them, do you want carrots or do you want broccoli? Right? You have to give some sort of guided governance, because if you ask your kids what they want for dinner, you're going to eat cake every day, and you're going to either have to break them down or enable them. And if you ask them if they want broccoli or they want carrots, you actually teach them how to govern, right? And so this is in the early stages, this is really what we should be looking for.
Stu, do you have anything to add?
Yeah, sure. So I'll give a anonymized example for one. But okay, so this is kind of the 16, 17 era. There's a protocol that has a very buzzy launch. And if you're one of the early investors, like you bought in perhaps at I think it was like 30 cents, right? Then they go out to do basically initial token listing. So working with an exchange to have that listed. They put it to the DAO to decide what that price is going to be at. And now the DAO has expanded far past the initial investors, right? Who usually should be incentivized to stay in up through that point. And they decide to list at 8 cents, right? And, sure, you can have like this belief in the project that, okay, maybe 8 cents is the right price and it'll go, it'll go up from there. And over the next, 5 years, it has gone up but for like the first 3, it really didn't. And at one point it tanked to below 1 cent. This pissed off a lot of early supporters of the project. And this is something that you will see when you open things up to token-based governance. I think that, as investors or as investor organizations, we understand also there is a game to play in the people we want to do deals with, the people we want to work with, the leadership we want to incentivize. But I think when you open that up to the masses, they will make self-maximizing decisions, maybe not as informed decisions. And yeah, that project really ostracized a lot of the early supporters, which also included some of the founders, and about more than half the founding team left since then. So that is something that you don't want to be a team that ends up doing that. So on the other hand, you saw I was not around for the earliest days of MakerDAO, but I do understand that they realized that it was really hard to build a decentralized autonomous organization with a decentralized autonomous organization. So I actually understand that they ended up setting up an adjacent entity, which would eventually dissolve, to help set, MakerDAO up, right? And I think something like that is interesting, because I do think it's, if everybody has a voice in the room around how to create an organization where everybody has a voice in the room, it can get pretty chaotic. So the idea of also having some kind of semi-centralized structures to at least set up those guidelines is not a bad way to go about it, and then progressively move into decentralization.
Yeah, and there's some mirror entities in the non-digital economy that kind of reflect this, right? There's in some cases, there's the perpetual purpose trust, the golden share, that kind of says we won't, you can do everything you want, but there's this one set of things you can't do, right? And then that wraps the large organization and instills its purpose, right? This is a European and American construct. And then Jake, what you were talking about with respect to how, you had people voting for their own Arbitrum founder allocations, right? This is really interesting when you consider it in a different context with potentially a mature firm that says, hey, we finally built this thing up. And we never took a cent from it and didn't take dividends or anything. What do you guys think we should get? Right? And this is what we think. And then your workers, maybe even your supply chain partners, everyone else is like, we don't think you should get that much. And also, we have the votes to make sure you don't.
The worst part is it's a binary vote. There's not an option to say, no, we think you should get this. The vote is yes or no. So even if you think they should get more, you're voting no, right? There's just, what are the chances that you just hit it so that you get it right?
Absolutely. It's a very good point. But I think the possibility is very interesting for folks who are looking at this and observing, you're like, oh, that was really bad. But imagine if you could do that within your own worker cooperative or something, right? Where you can actually say, actually, this is what we think you all should be getting. And they, there's a little bit of a trade-off or something, but you land at something that most parties think is equitable. Of course, there's a bunch of regulatory
Yeah, it
stuff
could be
I'm
cool.
skipping over here, right? But like, there's a lot to figure out. But that I think is an interesting promise. So I do want to stop here for a second. We do have 10 minutes, but I'd love to have some questions. Do we have someone to run the mic? Yeah, could you? David, and then we'll go David, and then we'll go Michael.
I love how David, another David, a lot of David, you highlighted that the role as an investor is, your oversight can increase the, governance and the, safeguards around the business. And what I'm wondering is, we've talked a little bit about governance here, but if I broaden the conversation to risk management more broadly and compliance, when you see things like MICA and DORA coming a little more than a year out, how do you view your role in helping to ensure that these companies, with $4 billion in losses in 22, the rug pulls, the pump and dumps, and really 80% of it's DeFi, hacks, a lot of which are just poor operational security. How do you view your role in ensuring not just governance in the form of DAO voting, but governance in the form of good risk management, security controls? And I'll just transparently say that I'm, a risk management company for DeFi, so I have a vested interest in this. But
Well, I guess we just hire you is the answer. I love this question because most projects in crypto and in tech start with like 4 or 5 software people. And then, Series A stage, we're talking like 15 or 20 people. And most of them write code. And almost none of them worked in a regulated industry or at a bank. And almost none of them are lawyers, probably none. And none of them are compliance people. And they've never done risk management. And some of these people are building exchanges and loan-based businesses, right? And they're taking leverage on their own balance sheet. So these are crazy things that most immature early stage companies in tech never have to face. But in early financialized companies, crypto, they do. And so like our message to our seed stage and then Series A stage companies is, we're bringing that in with you now. If you're getting closer to anything related to leverage or token creation, like here's the regulatory roadmap on a country or regional basis. Here is the profile of a compliance person you need, whether it's outsource or when's the right time to hire them. And these are foreign concepts to most like 26-year-old software entrepreneurs. But it is a requirement. And it keeps them out of trouble. And it actually increases the expense. This is one argument about why crypto actually takes a little bit more money to bring companies to market, because we have regulatory requirements, most of which is not clear right now. But still, the nexus between a crypto company and regulatory impact compared to a generic software company and regulatory impact, it's like, within the first 2 years, you're dealing with regulatory concerns in crypto. You don't deal with that in tech for like 10 or 20 years. So you've got to bring like policy people in, and you're like flying to Geneva or London or Washington, DC and talking to Congress people. Like this is all new. So the answer is like, this is where advice I think is helpful to young entrepreneurs. Like, hey, you have a whole bunch of other stuff besides just software architecture that's required here.
I think this is also, this really gets at one of the most interesting questions about governance in crypto, which is that the big difference between governance in crypto and governance in traditional equity is that governance in traditional equity is largely seen as an asset, right? When you invest in a company, you get preferred shares. You don't want common shares. Common shares have less rights, right? You'll pay a premium for preferred shares. And then if somebody tries to sell you a secondary common, you're going to pay a discount, a steep discount, because there are less rights there. In crypto, we largely see governance as a liability, right? And you see this with UkiDAO. So from the allocator standpoint, there's also a risk management concern, right? When we participate in a DAO, we do this through an SPV, because if you have an UkiDAO situation, and your venture capital portfolio is in bankruptcy remote from that DAO blowing up, then imagine if you just blew up a fund because they were participating in a stupid company called UkiDAO, right? That would be crazy. So you need to be cautious with how you exercise governance from within the fund. But also the big issue here is that the liability comes from the lack of really transparent and enforceable rights, right? That's the big part of preferred shares, is you have detailed statements telling you exactly what your rights are. In crypto governance, like we've talked about, the defaults are not clear. your rights are not clear. When there's a vote, you do not get notified. You don't have your 2 weeks to do it, right? And so this is where that liability really comes from.
We had Michael. We'll come back to that gentleman over there, and then we'll finish with Jan.
You can't really decentralize operations the way that you decentralize governance. Normally, you have a kind of a thin waist, even when you do have let's say we have a company-owned cooperative, like you're still not going to make every decision with the whole company. That would be insane. People have shit to do. And so I think in crypto, there's still this like weird notion that you're going to have this flat structure and that governance decisions are literally everything. And so I'm curious about how the panel feels about like actually not always having, governance make operational decisions, like broadly. I think the risk management stuff makes sense, but that's still just going to be policy making that needs to be implemented by a team that's not your investors.
Are we talking? So in an ideal world, this is my vision. It's a really good question. Like in an ideal world, absolutely, DAO governance is not making any operational decision. It's delegating. And what should a protocol DAO look like? It should look like some form of an endowment, right? Where it spins off enough capital every year to sustain itself in perpetuity. So really the governance decision-making comes down to high-level treasury management. And then with that money, you can then employ operators in a compliant way, ones that can protect themselves and risk manage appropriately, something like an Era Finance, the Gauntlets protocol that allows, essentially a decentralized aggregation of treasury managers to tell you, should you be going into Ethereum or into Bitcoin on your treasury, right? Like, because you should not make that. If I pulled this room, I don't think we would get the right answer, right? And so that's how I kind of see it. In the short term, I think we're pretty far from that.
Yeah, I totally agree. I agree.
Yeah, Thibaut from Fairmint. Yeah, I wanted to, like Michael said, like a little bit of perspective on governance, because it seems now like crypto is associated with like decentralized governance, but it was not always the case. And I want to have your opinion, because the way governance came into play into crypto was really because, as you said, there was the SAFT before, right? And the SAFT got struck down not because of the incentives. It got struck down because if you hold the SAFT as an investor, you were basically, the SEC said, you're acting as an unregistered broker dealer, meaning like you have the right to, when the token exists, sell the tokens to retail investors. And you should be registered for that. So this is what killed the SAFT. And after that, somebody very bright came with this other brilliant idea, which says, hey, you know what? Let's create tokens that only have governance rights, because if they have no other rights and only governance rights, then they are not securities. So the governance coming to play into crypto to avoid securities laws in the first place, and which begs the question where the tokens will accrue value. The only two tokens in the market today that have product market fit are Bitcoin and Ethereum, right? So there are two tokens. Okay, you pay gas, and this is how you make your transactions. Everything else is like pure speculation, and this is why like governance is a tried and true thing that has been solved in the corporate world, right? We know what good governance means in the corporate world. We cannot apply this in crypto just because of this mere fact that otherwise your token would be a security. And so yeah, I'd like the panel to address the question: where do you see tokens accruing value, like besides Ethereum and Bitcoin? Because in the end, that's the real question. Like people invest, people want these tokens because they think they're going to get value.
Sure. Yeah. So, I mean, where do tokens accrue value? I think it really depends by the model, right? One example would be if a token gives you access to a DAO's treasury, that is one form of value accrual. And then, the other, as you said, is if it gives you governance rights, and those governance rights can really, affect the direction of a company. It's kind of like a preferred share in that, in a way, it's like sitting on the board or having like investor preferences for the company. And that is, why you would be paying potentially like a premium for it. But, I think it's definitely right now in the world of split equity and tokens, it is definitely an open question for like any project for a investor to ask, does value for this project accrue to your token or to your equity, or to both? Or I think it really depends project by project.
Yeah, and I think like one of the, not to put them on the spotlight, but one of the sponsors for the event is Filecoin Green. And I guess it's a little idealistic, but for me as an investor, I really would like to see value accrual come from some kind of utility in the network so that you have a very solid utility token designation, right? So, decentralized data storage, eternal data storage, that sort of, speaks to me on the utility side. That's really a lot of what I would like to see in the network, and would address both the monopolistic dynamics around the last, 20 years of, sort of tech platform capture, in addition to new value creation. And Jake, you look like you have something to say.
Just one note on that. Yeah, it's right. The ideal scenario is that the tokens are not necessarily our exit liquidity, right? Like the ideal scenario, because if you imagine a utility token, if the price of a utility token goes up 100x, it's no longer that useful, right? So the price of a utility token should be bounded by some reasonable amount of bounds, right? You don't want to pay $1,000 per byte for your internet. So like the utility token itself could just be a typical internet token, right? And then we can have equity in a company that makes capital from using the network, right? Yeah. That would be very cool to see. I haven't been pitched that yet.
I will give you also just like one saying that, especially for people outside of crypto, I like to tell them, in a bull market, price is product. So in a bull market, basically token becomes the product. And that is what everybody watches on the sideline and says, okay, like, is this going up or is this going down? And honestly, people just do not care about what is actually the product, right? When Helium, for example, this decentralized router network was pumping, I think a lot of people did not even realize that it's trying to enable like decentralized IoT. They're just like, okay, Helium is going up. Maybe I go buy this device. I mint Helium. I like Helium. Helium goes up and then I sell it, right? So in a bull market, price is product. So basically the token is a product. I think the disconnect between the token and the actual product becomes way more apparent in a bear market where, you don't see either accruing like a ton of like very, very obvious value. And you have to focus a lot more on the underlying product itself. And this is to go back to, the original point that I made, that the best kind of token is the one that accrues value when the product accrues value.
Yep. Last question. Could we run the mic over here to Jan?
You mentioned, Studi, that basically you can't get governance in a decentralized way. The objective is decentralized trade, but you need a centralized institution building of some sort. So isn't that saying, and this is, I guess, what we've been talking about, what any market really needs, it needs kind of rules of the game, that the whole ecosystem of crypto is then, decentralized, not really kind of, it's the whole ecosystem isn't decentralized as a system.
What was the question?
The question is that basically kind of the public perception of crypto is that it's something that's completely decentralized. Whereas since the governance issues are so important and that all have to necessarily happen in a centralized way, that we kind of have to give up of this idea of this idealized idea that crypto is fully decentralized.
Yeah. So basically, do we have to give up on the idea of it being fully decentralized if we actually think that centralized institutions need to govern it?
I mean, I think this goes to David's point in terms of what stage is a company at. personally, like on day one, I would not want all operational and governance decisions of a company to be made by a group of their friends, right? Or a group of people that are vaguely interested and spent like $1 on a token or something like that. So I really think, this ideal of decentralization depends on the stage of the company and how many companies are, at the stage where, even my mother could participate in this ecosystem. And there aren't that many companies that are at that stage. So, I think that you can decide to perfectly decentralize a lot of companies like at this point. I don't think that it would be to the benefit of the ecosystem. So really, like, my belief is this progressive decentralization, where eventually, even like Ethereum Foundation, for example, sure, they have a lot of perspectives, they set roadmaps, but they don't actually execute on everything in that roadmap. Their end goal is to be able to step back and actually no longer have to build and enshrine things into the protocol, because the ideal end state for Ethereum is that there is some kind of ossification. Because when there's ossification of this protocol, then even institutional investors know what to expect, right? Since you no longer have a centralized committee of people saying this is what Ethereum is.
Yeah, maybe the framing of the question might suggest a bit of a false choice. So I don't think that to believe in some of the value or promise or interesting pieces of crypto, you have to believe that it must exist in a world with no governments or no centralized money supply. That's an extreme view. And today we have crypto existing in a world with plenty of governments and centralized money supply. So I don't think like these, and I would call it still experiments in decentralized structures of running technology organizations or decentralized treasury management. I don't think that for those to produce interesting outcomes, you have to also believe that there should be no rules and no government setting any regulations. The challenge is that these are global by nature. Every single product is global instantly. So whose rules govern the road? And we are fighting over that right now. And will certain governments allow for more experimentation here than others? And that is what we're seeing now. We're seeing Europe and the UK and Hong Kong and Singapore and some Far East countries say, please come experiment. Maybe it's a utility token. Maybe it's a security token. Maybe it's a governance token. Try them all. Let's experiment a little bit. Let's try to make sure people don't get hurt too badly. So let's put some guardrails around it. But like, this stuff is interesting. Let's play around a little bit. Personally, I think that's how innovation is fostered. That's how we find our way out of problems. Most of crypto is a reaction to some of the weaknesses of the Web 2 model. I mean, if I could just for a minute, like, we're in this world of AI. Your panel discussed the impact of AI. AI requires the output of all the people in this room to train the models. It has read all of your websites in order to train the models. How much compensation have you received from OpenAI or Microsoft or Amazon or Apple for looking at your photos and getting smarter, or looking at your blogs or your academic papers? Your book has probably been scraped. None. I have no shares in OpenAI. I have no tokens in OpenAI. But Web3 believes if you're a contributor to networks, maybe even AI networks, you should get something back in return for that, maybe proportional to the amount of participation or contribution. That to me is a very interesting concept for us to invest in and explore, and also a very just and fair one that also might go to some of the core concerns of your panel, which was like, how do we decrease inequality economically? Well, maybe if all of our output is always being rewarded with some ownership or economic participation, that may go somewhere.
Jake, last comment.
Jahed's going to kill me because we're definitely running over time. But just a clarifying point, the entity that Studi was talking about, that's a centralized entity for Maker, is an orphan foundation. So it does not have ownership. So while it is quite literally a centralized entity, there is no ownership. Right, so it is possible for entities to remain decentralized if you take one trust assumption, which is that the director is going to follow the law, is going to do what they're told to do.
Thanks a lot to all the panelists. We're going to take a 30-minute networking break, and we'll be back at 11:30 for the next panel.